Hi, welcome to the Seller Finance and Creative Deals podcast. I'm Dan Deppin, and today joined by Shante Duffy. Shante, how you doing?
Good. How are you?
Good, good. So excited to have you on. So some people who listen to this will like know Shante very well. Others, she might be new. Like we'll get into it, but you've been around the investing space for a long time, and now as of a little while ago, helping out part of the Call The Underwriter team. So maybe you can give us like a little bit on your background and kind of how you got started and like real estate investing and notes and
Yeah.
loans and all that.
So my story begins with being tired of being a stay-at-home mom. I have a 13-year-old son now. He's in eighth grade, but I stayed at home the first year and it was great, but it was also horrible for me. I was bored. So I decided I wanted to go back to work. I didn't know what I wanted to do. So I actually found an administrative assistant position at a loan servicing company. And that's actually how I dove in. I knew nothing about loan servicing, very little about mortgages. I just knew you had to pay it or you lose your home. Pretty black
Mhm.
and white. Didn't know that, there were investors. I just thought it was always big banks. So I kind of learned from the ground up, starting as an admin assistant, kind of climbing the ranks and just learning. I used to work, as many of you may know, at Madison Management Services. Absolutely still adore them, still recommend them to everybody I come across as an amazing servicer. And then a couple of years later, I got an opportunity to kind of branch out and create a servicing company, which did kick off. It went well for a little while, and then things changed, businesses changed, the world changed. We all survived COVID, everyone that's here today. So things changed a little bit. I did that for a while and decided that maybe I've reached my peak in servicing. So then I was kind of looking for something different. I've also done some asset management on a smaller fund side, where I kind of just manage the servicers, manage their portfolio, was able to find new assets to buy, also sell assets and everything in between. So that was good experience, hands-on more so instead of kind of overseeing servicing. And then I kind of just been lying low, still doing some basic servicing things and some mentorship as well. And I then got the lovely call from Dan. And Dan, you actually were kind of letting me know, which I had heard that you had purchased Call The Underwriter. And I was like, listen, I'm in the middle of actually getting my real estate license here in New Jersey and would love to kind of learn all aspects of this side of real estate. So I've done the servicing, foreclosure, bankruptcy side. I've done the asset management side, working as an investor. I'm an investor myself. So, kind of got through that. Never understood the underwriting side, though. Loans always came to my desk as a servicer once they were created. I didn't understand the guidelines and everything that you needed to create a loan. So this has actually been an awesome opportunity. And I just love to learn. So learning anything new and kind of learning an entire process, start to finish, has me super excited. So I'm having a lot of fun with Call the Underwriter and learning and questioning things and just trying to get some good footing, making sure that we're compliant, making sure that if we're not, why, if loans don't get approved, why. So it's actually been a really fun journey these past couple of months. I'm enjoying it.
Yeah, that's cool. I think you were one of like the first people I met in the notes business because I think it was around 17 or like
Yep.
early 18 when I was getting set up with Madison. Yeah, you're like one of like the very first people that I interacted with
Yep. I
in the
remember.
whole business. But yeah, it's funny how like the different sides of the business all are very you have different things that you care about, right? Like and the origination side is pretty like it's fairly opaque. I don't know that there's a lot of people out there that really understand like the origination side, like really in depth. Because like most of the loans that get originated are done like incorrectly.
Correct.
Yeah, and there's definitely a lot that goes
We've
into
seen
it.
them all. There's a
Yeah.
lot, but it's actually kind of, I find it really interesting having to get the understanding. Not just, I just kind of thought people were approved based off of gesture credit alone. Didn't really kind of know in your income, like basic information. Didn't realize that
Mhm.
there was things that you actually to look for, like how deep this actually went. So it's cool to kind of be in the driver's seat at that side, knowing that what comes out of this is the notes that, I used to service, another servicer service, and going through the note life and the loan life is different than the creation of, are you even able to get a loan? So I'm actually having a lot of fun and hoping that I could take this knowledge and wrap it into, some real estate license things such as, buying and selling homes, commercial real estate and things like that. So I'm just thoroughly enjoying expanding my knowledge and growing and learning. And this is definitely a fun side to be on. It's different. I still think like a lender. I still think like a servicer. So my brain is comfortable there. But I'm learning more outside and just talking to different lenders that are originating and realizing that things that they don't think about necessarily of importance at originating side does affect the loan life down the road. So it's good to kind of have those conversations and bounce them back and forth. And again, coming from the servicing lending side, it's like, well, you should be concerned about this. You should be concerned about, debt to income ratios and how tight those are and, stuff like that, where some people are just like, oh, it is what it is. I just want to get this going. So it's very
Right,
interesting.
'cause people don't know what they don't know.
Yep.
And yeah, on the lending side too, it's interesting how sometimes folks are like not as interested in things that I personally find like super important. Yeah, like
Yep.
the debt to income ratio. Like sometimes people just want to know that if I create this loan, is it compliant? And that's
Correct.
important. But to me, as like an investor, that's like a minimum bar. Because
Requirement.
if I create it, it's compliant, that's great. But if it's like a bad loan and now I'm going to have to have
Deal
issues
with a
later,
headache
like
later.
that's a giant pain. One thing I'm curious about now, you've seen like the servicing side, the origination side, like from a compliance perspective, like which is worse to me, like
Servicing.
servicing always seem
Hands
okay.
down servicing. There's a lot more red tape. But again, I think servicing is also a little bit different because it's state specific. There's state specific laws that we have to follow as a servicer, as well as just federal laws that we have to follow. With underwriting, it there's still compliance components. It's just not as strict. It's not as airtight. And it's a simple yes, this works or no, this doesn't. Where in servicing, it's to me a little bit more creative. You can not necessarily finagle, but if you have a borrower that's just not paying, you can work out some loss mitigation options. You have additional options. Where in the underwriting side of things, it's either they are approved or they're denied. It's kind of just black or white, which I like. The gray area is still really fun, but on a compliance standpoint, servicing required me to remember a lot more. Which it does help and it helps talking to these new investors who are, hey, I want to originate this loan. This is what I want to do. What do you think? And when they ask that opinion, it's kind of like, okay, well, remember, there's still a loan after this that you now own and are expecting payments. So it is different. This is more black and white. It's pretty simple, cut straight through. The only
Yeah,
difference is really just the person we're working with. Some people are self-employed, where some are just, W-2 employees and things like that. So other than that, as long as you have an income, we're just kind of verifying it. So I do like how cut and clean it is. It's pretty simple. But it's definitely fun. I'm enjoying it and kind of like, why would anybody do this or why are we offering this? So it's cool to see. It's cool to see because I've serviced a lot of loans that I've always questioned. So see how it kind of starts is actually amazing.
yeah. Funny because like I always considered servicing like more challenging, but when people look at like getting into different like businesses in the space, it seems like everybody and their mom always wants to start a servicer. And that seemed like the last thing I would want to do. And then the origination side, people seem to be scared to death on the compliance stuff. And like once you know it well and you have your system set up, like
You're good to go.
it's pretty straightforward. And like my takeaway, spending a year and a half or whatever diving in on this is really all the compliance stuff and originations is kind of stuff like I would want to do anyways as a lender. Like I want to know my borrower has the ability to make payments. And I want to like disclose everything ahead of time because so we're on the same page. Because I've noticed like when I've owned like non-performing loans, like ones that I bought from somebody else, like a lot of times the borrowers will be like, well, there's some disagreement. Like this guy told me this, or I thought it was going to be like that. And that always leads to, can lead to loan performance issues.
100%. Where this is kind of
Well,
outlined and agreed upon up front. And I think I like the transparency. I think that's a good way to put it. Disclosing all information up front, it makes it very clear. We've had borrowers that come back and, hey, this doesn't work, right? That doesn't make sense, or this wasn't what we was discussed. at some point. So they're fixable. And like you said, it doesn't necessarily change the performance of anything yet because we haven't originated it. This is just the beginning points of, does this work for this borrower and this lender? Can we get on the same page? The terms work out as well. Terms are important. And it's kind of good to get that feedback and kind of work with lenders and borrowers at the same time. So I still kind of get the best of both worlds. In
Yeah.
servicing with borrowers and lenders, this situation with Call the Underwriter, it's still borrowers and lenders essentially at the end of the day. So I still get to have that communication, which is always what makes me happy in this space.
Borrowers, so it's not like you're dealing with like the borrowers in foreclosure and whatnot.
No, these are
It's
nice
like
borrowers.
before. Yeah. They're
They
usually,
are not as emotional. I think they're more excited, I should say. They're
yeah.
more excited because, oh, I'm getting a home opposed to I'm losing a home. But of course, you still have some people who get upset who don't qualify, and you just have to be honest and why they're, you don't qualify, you're not in compliance, you don't have enough. These are the problems. And the best thing that I love that we do is we let them know options to fix this. So if there is a reason you don't qualify, it could just be something on your credit that needs to be cleaned up. We want you to take care of conditions and we'll give you that information. We'll tell you what needs to happen to have things change. And it's up to the borrower to take that upon themselves to clear those conditions, but it's also the lender to upon them to also ensure that the borrowers do this for the best outcome. You always are still looking for a win-win.
It's one thing I always like to do too, or like propose things to the lender. Like, here's how you could potentially like restructure things. Maybe you need to stretch the term and lower
Yep.
the payment, or like you said, like if they have like some accounts and collections, it's like, okay, they could clean these things up or do this or that, or the other thing like people have done before, like if their debt to income is like a little bit over, they can pay off a debt,
And
drops
then
their
it balances
monthly
out.
payments, and then their debt to income goes down. So yeah, like a lot of times it's kind of like, I mean, it's a different process, but it's a little bit similar into like working out non-performers, like you were saying, like there's all these
Absolutely.
options for like forbearance agreements and like different things you can do. You can do a little bit on the front end. You can do some of that on the front end as
As well.
well. And then like the other thing people will do sometimes is like if they get a borrower that they're not, maybe it's not compliant or they're just not comfortable with, right? Because that's the other thing too. I think sometimes like lenders don't realize like just because a loan is compliant, they don't have to do it, right? Just like a bank, you can have your own standards. Like for me personally, if something's barely compliant, I'm not going to want to
You kind of want to run away from
create
it.
the loan. But sometimes what people can do is like they'll put a lease option in place
Yep.
for a while. They'd be like, okay, well, we want to really have your debt to income here and your credit here and clean these things up. So we're going to do a lease option for a while. And then to exercise the option, you need to clean up these other
Yep.
things. And then if you do all that, then we'll create the loan and then everything is good to go
Absolutely.
at that point. So what were like some of the surprises on the underwriting side of it that you didn't expect to bump
I
into?
think I think what shocks me the most is not actually like the processes. It's the fact that I've definitely seen some files come through that I'm like, why would you even apply right now? Um, it kind of throws me a little bit. Maybe it's just how I was taught and raised. You should be paying attention to your credit score. You should know what's on your credit report. I think I always went through the life of the rule of thumb that if you don't have a good credit score, you're not really going to be approved. And a mortgage is such a hefty loan. I'm not saying that these are millions of dollars worth of mortgages, but it's still it's more than a car. You know what I mean? It's not just a credit card, you know what I mean? So I think I'm more shocked at borrowers and their applications and with the mindset of you're creating a mortgage here. So you're going to have a loan and realizing that this is somebody who's purchasing a home as their primary residence, but then you have a credit score of like a 580, which again isn't the worst case scenario. But when you look at the credit report, it's like, well, you don't pay things. I think I got stuck on a file at one point where I had to review it with you. And I was like, they have an existing mortgage that's delinquent. Like out of the gate, this is just a red flag. And it kind of always confused me as from a borrower standpoint, like why would you like if I wasn't in a good position, I wouldn't go and apply for a mortgage. So my brain gets stuck on, do you not know what's going on in your own personal financial world? But then the flip side to it is then we have lenders who just genuinely don't mind. And
Yeah.
I think that scares me more because, again, my brain and everything in me wants to go back to the loan and think of the note in the future, paying it down, and the loan's eventually going to be with the servicer. Like my brain goes there. So it's like this borrower is not, the lender might not care, but this borrower is not going to perform well either. And when we tell them that, hey, when we let a lender know, like, hey, this really isn't Dodd-Frank compliant, and we give reasons, I was very shocked to have lenders say, okay, but I'm still going to go do it. And it's like, uh, uh,
It
I,
happens.
I kind of choked up a little bit. And that's what shocked me the most. I think the
Mhm.
process itself made sense, gathering information that is needed for this application process from the borrowers and the term sheet from the lenders. I think it's more of how the individual parties are that I think is what's mind blowing for me.
Well, and I think it's because a lot of times, like, especially when people are new to it, like what I've kind of learned, one of the big things I've learned that's kind of surprised me is the note creating investor persona is very different than like the note buyer.
Yep.
Like they're radically different, even though they're
Yep.
involved in the same things. And oftentimes, like people who are like buying notes don't understand creating notes like at all. And then people who are creating notes often are not
Don't
familiar
understand.
with like owning a portfolio. So a lot of times it's like people don't know what they don't know. But yeah, I mean, if you're going to lock yourself into like a 30-year payment stream, and if it's not compliant, you've got all these problems and like given the trade, like you're not really going to be able to credibly sell that loan unless you take a gigantic haircut, you
Off of
know,
that.
from
Yep.
someone, that's going to be tough. But yeah, that kind of stuff happens fairly commonly, and I kind of try to let people know how like it's in their best interest to have the good borrower because whether you're selling the loan or holding on to the loan, you want somebody stable. The other thing I've kind of observed is people who haven't necessarily had experience owning notes or haven't had experience with non-performing notes and gone through like that legal process, they have a tendency to think it's easier than it is. And like we both know, like having done a lot of those, sometimes they are kind of easy, sometimes they do go smooth, but then other times, like, you get into the ones where the borrower fights and they drag it out and then they file bankruptcy
Yep.
before. And I think sometimes people don't appreciate, like, if a borrower wants to drag things out, even if you're in a, super fast foreclosure, non-judicial state, like it can be
They
a
will
minute
drag it out.
and it can get really expensive as
And I
as
think
things
that's
go
what
on.
people aren't aware of if they're naturally just originating and not used to being a note investor. I don't think they think when you're a note buyer, you're constantly thinking of, you're taught to think about exit strategies, what happens if this goes non-performing. That's how we all were taught. I think on
Mhm.
the origination side of things, you're not taught about the loan after the fact. You're
Yeah.
taught about what is needed to create the loan. And I think that's where the big disconnect is. And I think that's kind of what makes at least us in this situation a little bit more special off the strength that we have the experience as to, okay, well, if you hold this note, understand that you are kind of walking a line. We don't know, this borrower's debt to income ratio is very tight. And it's kind of like, are you sure? So I think us also giving that knowledge back is what separates us a little bit from other origination companies off the strength that we have the experience on the other end.
Yeah.
So it's, we are able to tell stories from history, from experience, from not, I mean, I worked with a servicer, I've seen a lot of different things. And to share that and just say, just so you know, this may happen, this is a possibility, and understand that you're kind of in this window at that point. And then to remember, you still have a servicer to work with, you have servicing fees, you need an attorney, those fees are, they're high. Borrower start
We can talk a little
foreclosure.
bit about like why people need a servicer because the other thing that like a lot of clients like I talk to who are doing this and they're relatively new to it, they're not really necessarily even familiar with like all the vendors that they need and all the pieces. And so sometimes people don't know like that they need a loan servicer or what they do. So maybe you could.
As I've always
uh,
said, and it's been about what, 12, 13 years now, you don't like servicers as an investor, but you need them. You absolutely need a servicer. That is a number one vendor if you plan on originating loan or just buying a loan, buying a note. You need a servicer, and that servicer needs to be licensed in the state of that loan. So I live in New Jersey, but I have a loan in New York. So I need to put my loan with a licensed servicer that is licensed to service in New York. Your servicer is responsible for processing all your borrower's payments, keeping track of that payment history. Some servicers in this world do report to credit bureaus, some do not. Those are questions you should be asking. But your servicer is responsible for sending statements, late notices, processing payments, and keeping your loan in compliance even after it's been originated. At this point, there's still a loan that needs to stay compliant. So that's why your servicer is most important. They also do the borrower outreach and communication so that you as an investor don't have to. It's you really shouldn't be talking to your own borrowers. It's money that you put up in some way, shape, or form. There is an emotional tie to you and your loans, whether it's emotional, financial, there is a connection there. Your servicer becomes that like middleman. They work for you, you hire the servicer, but they also work for your borrower. They don't want to see your loans go non-performing. They want our servicers want your loans to stay performing. You guys keep getting your payments. It's very simple. It doesn't always work that way. There are times where borrowers' loans get bought and sold. Borrowers lose jobs, things happen to where a loan ends up becoming non-performing. Your servicer will help you get this loan re-performing. You'll give them different loss mitigation options that you're interested in, that you would like to make available as an option to your borrower. The hardest part out of service in the servicing world, and I tell every investor this to this day, it's your borrower's ability and willingness to also communicate. Lenders, you guys can't go ghost on servicers. They can't make decisions for you. We don't get to decide, oh, Dan, you have this loan in Pennsylvania, it's not performing. We're just going to go modify it. No, we need you to tell us that you want us to modify it. We'll give you options. We'll make sure numbers are correct and things like that. But lenders need to be involved, and so do the borrowers. So if your borrower is not answering, that becomes the challenge. And again, that's something that we can't force, but servicers are trained in debt collection practices. They know how many times they can call and reach out to a borrower, how to leave voicemails, messages, what they can and can't say, who they can and can't talk to. That's your servicer's job. They will make what the goal is to make whatever plan you as the investor want to work with the borrower. They are your middlemen, they are your voice. That is their job. Most servicers have a portal. You can view everything that they're doing. A lot. You should be able to look at that before you have to email questions. I always tell people, whoever your servicer is, 9 times out of 10, I've yet to see a servicer that doesn't have a portal that you can at least find out, did my borrower make a payment? That's usually the most common question. It's important for investors to track their loans and stay on top of that. You are paying your servicer for a service. So make sure you know that the services that they're giving you is exactly what you want, exactly what you need, and it fits for you. Working with your
The
servicer
other
is
thing you can
important.
do, like as a loan originator that people don't realize is you can just like with the like the underwriting fees and the other things, you can pass those on to the borrower. Like you can pass the loan servicing fees on to the borrower as well. So
Yeah,
like the 25 or 30 or 35 a month, like you can have your borrower pay that. So it's interesting how like when people get spooked about compliance, whether on like the origination on the servicing side, they either go, well, I'm not going to do consumer stuff because I don't like the compliance. Or they go, I'm just not going to do the compliance because I don't want to pay for it. That's kind of, to me, that's kind of silly because the borrower will pay for both of those. So like you as lender, like it's actually like a freebie on both sides
at
of
the end
it.
of the day.
So it's
Yep.
kind of crazy like not to do it. Because if you sell try to self-service um
I don't
a
recommend it.
consumer loan, like I don't think there's any way on earth you'll ever comply. Because the other thing too, I think that the reason people don't realize that is they're often coming at it from experience with hard money loans and like investor loans, which is a different rule book. They're a different like loan
Yep.
structure, like what makes sense on hard money loans and like owner occupied loans are kind of apples and oranges. And I think the other reason people kind of um, underestimate what they might be in for if they have to foreclose is because a lot of their experience is with renters and maybe evictions. And even though you can have evictions go sideways, like that's a very different
Different animal, different
process
process.
as well. But so yeah, so the thing is like once you turn something into a loan, you're kind of more like locked in. Like if it goes wrong, like you got to do more
Yep.
to fix it. But kind of the advantage of it is it can be a way more stable payment stream. You don't have like renters coming and going. you're not on the hook for like repairs and,
Yep.
other kinds of stuff. The borrower's dealing with all of that. And then if you created a good loan, you can do a lot with it, right? Like you can hold it, collect the payments, you can sell it. Like sometimes people don't even realize they can sell loans. Like I've talked to
Mhm.
somebody the other day that didn't know you could do that. I'm like, yeah, absolutely. Or like you can sell partials. Like so a lot of times people who are doing creative finance, they're into all kinds of different stuff. And so if you're like, okay, I got this 30, 20-year loan, I like it, but I want some cash to do whatever, you can go sell like 2 years worth of payments to
Yep.
somebody, keep the back end and do that. So sometimes people don't realize like all the flexibility they have with them that you don't necessarily have with other kinds of investments. So they're kind of nice in that
Correct.
way. Yeah.
There's
So
a lot of room. There's a lot of wiggle room and flexibility. So it's definitely different options available.
yeah. So on the underwriting side, like how much do you hate going through bank statements? Because like one of the things that I learned was right, so like traditional like banking, lending, or the government backed program, like they heavily favor W-2 employees. And I think
Yes.
I always felt like part of that is this like notion from 70 years ago that if somebody has a W-2, they're going to be employed for the next 40 years and get a gold watch, which is not true. But the other
Not
thing I've
today.
realized too is just it's a hell of a lot easier to underwrite a W-2 borrower because you get like the W-2 and
100%.
the recent pay stubs and it's dirt simple, you know.
I love the W-2 borrowers just because they are simple, but I'm a child of business owners. So I just constantly think so my mom would have had to submit all of this every time she bought a new house. Because she owns her own business. So I don't love it. It's growing on me though because I have a better understanding. I think just looking at bank statements at first, I think was just a lot on a business standpoint. And I was just like, well, I don't really know what I'm looking at. And then I realized I'm like, wait a minute, I'm trying to calculate their income.
Yeah.
So once I kind of forced myself to realize like that's what I needed, it became a lot simpler. They're still not my favorite. Especially if you don't, it's not even like the process itself is hard. It's just getting the borrowers to send the most 12, like past 12 months worth of statements. I had a file the other day where someone sent me a 2024 tax return, but 2023 bank statements. And but on their application also had a different amount of income. So I kind of sat there. I was like, well, I'm seeing three different numbers, but out of the gate, this doesn't work. The amount on the
We're
application
all low
worked.
on that one.
Yep.
Yeah.
And then I just realized I was like, this is all, and no matter what I had, it didn't work. The borrower didn't have enough income. That's just what it comes down to. Business has been around for a couple of years, but it's it's more interesting when you get the borrowers that submit everything properly, which means they're reading their applications properly, they're answering properly. That makes it easier. But again, it's no different than servicing, chasing people down for information that you need. And there's still an investor involved and there's still a borrower involved. So as long as they provide it, it's fine. I think what is a big, I want to say thorn in my side is, and it just, to me, it's a process thing. I'm used to, trust me, I was the one setting up investors in the servicing world, just getting them set up and then boarding their loans. So it's kind of very similar here where the investor fills out a term sheet. That's how we know that we have a new file to underwrite. And we get that term sheet, and instantly the investor is notified as to what the next steps are. So we have all this automated and it's great, but it's the waiting game. And I'm realizing I
Yeah.
don't like the wait. And again, you're jumping from file to file, so I'm focused really hard on one. It's like, well, I don't have a total income picture here, or hey, I don't have their credit authorization, so I'm stuck. So I have to wait for certain things. I think that's probably the biggest thorn is getting the borrowers to complete like, and I get it. An application usually we get the most of the authorization form. Again, we get those pretty quickly. It's the income. I need you to
Uh,
provide income that takes
Yeah, because we
forever.
asked for 12 like complete bank statements, like all of the pages. And a lot of times people will send like last
The first
month's.
page.
And
Yep.
then you go, yeah, or they either send one month and you're like, no, we need all 12, or they send the first page of everything. Because what happens is like, and there's different like shades of gray with the bank statement. Some of the bank statement ones are actually pretty straightforward. Like if somebody's got a separate business bank account, which you should really have anyways. And everything's sometimes they're super clear, like it's fairly straightforward. But then, I've gone through a lot where like all their personal and business stuff is
Or mashed
munged.
into one.
and they don't have a bookkeeper, and so you're basically like reverse engineering a profit and loss statement from their bank statements, which can be hellish. Yeah, so it kind of goes anywhere from look at some W-2s and pay stubs, and it's like 5-10 minutes to hours
Bank
of
statements. Yep.
like digging through
But
all
I
of
think
that
it's
stuff.
just getting the information. As long as we get it, then I think once we get it, we're usually fine with moving forward in the process. But it's the wait. Like I was going through our list and I'm just like, okay, well, this guy filled out a term sheet, you know, a month ago. And we've sent numerous emails to the point I'm like, is this a dead deal? Are we not doing this? And then it's like, well, we don't hear from the borrower. And then I kind of get confused. I'm like, well, this is not a loan situation yet. This is you applying for a mortgage. So I'm kind of like,
Yeah,
wouldn't you be
and all of them
excited?
are different, right? And like different investors kind of operate in different timelines. So a lot of times somebody's, selling a house and under finance, they found their borrower and they want to go. And that's
Yeah.
probably most typical, right? Like they want to get this stuff and get this through. Other times, investors are involved in all kinds of different things. Neither the borrower or the lender are in a big hurry. And sometimes they just, like I've had them like kind of almost simmer for
Yep.
like a few months and then they
I
come
think
back
we
and they're like,
just brought one back from like June and it's already
yeah,
September. So it's like it's just it's there. I think for me, I'm like, oh, well, I would naturally think I'm gonna go get a house. I'd be on top of it. That's just me. But I'm realizing, I mean, it's just still people. We're all different. We all do things differently. We all have lives as well. And we were in these self-employed, people, they do have jobs and companies that they're running. So it's not like it's challenging. It's just I'm not a patient person, that's what I'm learning. And this is testing patience at times. And it's like, okay, it's like, so I'm going through this. I'm like, I still don't have this. And I don't want to over harass. And then, it's not the lender's fault, so now
oh yeah,
we're
it's
both,
funny because I've had people like we'll get like the last piece of information and then the lender will be pinging me like, hey, you've had this stuff for an hour, like where's the file? And it's like, whoa,
yeah,
it takes a little longer than that. And then we've had other ones where, like I said, it's kind of dragging out. We're not getting stuff from the borrower, so we're like trying to remind them like, hey, we need this and that. And then they get annoyed, like, why are you bugging me? Like, we'll get it when we get it, kind of thing. And then I've also had ones where it kind of drug out. It took a while. We didn't bug them. And then they come back and they're like mad at me, like, "Hey, why'd you
yeah.
let this stay?" So yeah, you kind of like everybody's on a different timeline and in a different mode. So kind of like what we've been trying to do is put some sort of
We put a
automatic
process together.
reminders and
Yeah.
kind of like a process in place, like here's what to expect and that kind of thing. But yeah, everybody's like all these are kind of special butterflies that are a little bit different. So it's hard to have like a one size fits all thing is kind
It
of
doesn't fit
challenging.
here. It does
Yeah,
not fit here. And I think that's why I like this so much. I think that's why I'm enjoying it because as much as it's the same thing, it's really not. Like, yes, I still have to follow the same processes, right? But it's different borrowers, it's different lenders. I think the best part that my favorite moment since being here has been seeing some investors that I've known from the servicing world just
yeah.
because I've serviced loans, kind of be like, wait, is this Shante from like years ago at Madison? I'm like, yeah. They're like, oh my gosh. So it's also exciting to see where investors, when I met them, where they started.
Yeah.
And then to see their growth, I'm like, wait, you start. I'll never forget it. We did two files for somebody who I adored at Madison, still adored to this day. So it was really exciting to, work his files. But it was like I watched when you didn't know anything, and you're a brand new note investor, and then to see you fast forward, 5, 6, 7 years, and you're now out here originating. It's just super cool to see. I love watching people's growth as well in any part of this industry. I think it's fun. It's not for everybody. I've also seen people say like this is not it and I don't want to touch this and it's a lot of work. So I've seen both sides, but it was definitely like heartwarming to see some names pop up. I'm like, I know them. I've met them. I've had dinner with them. I've serviced their loans or what anything of the sort. So it's actually really cool to just see the growth of no investors that I knew as only no investors now originating their own loans.
One of the things I enjoy is like it seems like when because I've over the last year, like I've seen like a number of people do this. Like once they start creating loans and doing seller finance, like they'll do one or two and they'll figure out their model. Then they tend to spool up. and
Yep.
do a bunch, right? So like in like the note buying world, there's maybe like a handful of people that do that, but most kind of don't. In like the note creating world, investors tend to be way more aggressive.
Yep.
And once they figure out something that works, like they just start going. So they're kind of like fun folks to
I
work
love
with.
it.
They're looking for like, how do I do stuff? Not, oh, I'm scared. Why should I not do this kind of thing?
Yes. And that's what I think is what makes I've seen so many people leave just the note world. So I think that's what made it so like warm and fuzzy for me. It's like, wow, you've come a long way. And then I think just talking to you sometimes and we go back and forth just in certain meetings that we're having and we're talking about ideas and people and just even the marketing concepts of things. It's like there's so many people out here and there's so many ways we can do this. And for us, I think we get so excited. And then, but we're also like, we now need to organize this before, like, we know not to run before we walk. So the idea is
Yeah.
here, the great idea, but then, you've been really good with game planning and okay, let's do this smart. I think steady and stable is the best way that this has been actually working with even the changes we've made since I've came on board. So I love every part of this right now. It's different, it's fun, it's interesting, it's not boring. And I mean, sometimes I'm challenged and there's times where I'm like, I don't know what to do with this one. And a lot of it's just like my inner natural heart goes to the servicing world. So I think like an investor at that point, but I'm like, not everybody thinks like that either. So I've genuinely like enjoyed this a lot and I'm loving every part of it and can't wait to go to where we're planning on going.
Awesome. Yeah, I was super excited when you agreed to come on. Yeah, and we'll get into this like down the road, but yeah, we'll be, bringing on another person most likely next month, and then,
Yep.
throughout the course of the next year, there will be some other changes and like additions to Call The Underwriters. We start getting licensed in more states, and we're doing things like non-QM lending and all of that. So yeah, excited to have you here as like kind of like the hub of things as we kind of add people on and grow. So Fante, so thanks for doing this. I really appreciate it.
No, I love this and I love working with you and I'm thoroughly just enjoying myself and I'm super happy and grateful. So thank you. And thank you for having me.
All right, thanks.